All right, thanks very much. Now I'll be attempting to do what all the speakers before me have tried to do, and that's present a 5-hour presentation in 15 minutes. Let's see how we go. Just quickly, you've covered UniSuper well. I'll just make it a point that we are dedicated to Australia's tertiary education sector, and we're very proud of that. But you've got to keep in mind that if people feel passionate about this subject in general, multiply it by about 10 when you think about our constituency. It's really important for us to get this right. And also make the point that we are the largest manager of ESG themed strategies in Australia. Now, I'm going to break up my presentation in two broad areas. One, I'm going to talk about exactly what we do, and then we'll talk about the lessons we have learned and indeed are still learning. And unfortunately, I don't think anything I'll say is particularly inconsistent with the previous two speakers. So that's good news. Right, in terms of what we do, I think it's important to get a bit of context here. People tend to group pension funds or super funds, they're the same thing, and sovereign wealth funds and endowment funds in one group. Of course, we're different beasts because there are vastly different governance structures. With Australian super funds as fiduciary, we've got to satisfy the sole purpose test. And that means that everything we do has to be in our members' best financial interest. That is part of the Superannuation Act. Now, when it comes to climate change, long term, there's no problems with that because we know in long term, best financial interests and dealing with climate risks are one and the same. Over the short term, though, it can pose challenges. If you think about 30% of our members are actually in retirement phase. So when you're talking to a retirement member, they do say, hey, listen, all well and good, you're talking about commitment to Paris and climate risk, etc. But I'm thinking about my pension for the next couple of years. So how are you reconciling that with your fiduciary responsibilities? And it's a fair point. So what we've done is we've framed the challenge differently. We've moved on from talking or debating about climate change. We don't get into a debate about what levels the seas are going to rise, where's going to be the most impacted by extreme weather, etc. We talk about decarbonisation. And we say, look, it doesn't really matter, okay, in terms of arguing the economics, etc. One thing we have to accept as essential and inevitable is decarbonisation. It will be potentially the most dominant investment thematic for at least the next decade. And it's incumbent upon us as a major asset manager to be aware of the risks and opportunities that's posed by this all-pervasive theme. And when you talk about decarbonisation, we are now reconciling our fiduciary responsibilities to act in members' best financial interests with indeed looking at climate risk. Right, now what does this actually mean for us in a practical sense? I'm coming from a practical perspective here, and I'm just going to list a few. This is not an exhaustive list. In terms of portfolio construction, we basically exited thermal coal. We don't see how thermal coal has got a role to play in any sustainable scenario. If you think about stranded assets, and this is very consistent with Laura's slide that Laura put up, is it lends itself most to the stranded asset risk. So we've exited that. We've substantially reduced our fossil fuel exposure. We haven't committed to exiting it for a couple of reasons. We believe that there are fossil fuels required in a transition. We're absolutely committed to net zero 2050, but we will require fossil fuels to get there. But there are also companies that are essential to make the transition that still do have fossil fuel exposure. I'm not going to go into them, but you don't want to starve those companies of capital. They need support to make this transition. We want to target a lower carbon intensity across all of our mainstream portfolios where indeed it makes sense to. With some of our portfolios, such as our direct property, we think we're pretty confident of getting to net zero within the next couple of years. So we've set a target of late this decade, but we're pretty confident we can get there by 2022 for property. Infrastructure, maybe by 2030. There are some that are going to take longer. And some, it's important for them to actually, even though they're increasing their carbon intensity, they're the companies that are actually required to get us to net zero. One of our most popular portfolios is actually a global environmental opportunities portfolio. And that has a battery manufacturer, it has a solar panel manufacturer, it has EV manufacturers. Now these are pretty heavy emitters, okay? They're growing very quickly, but we need these companies to get to net zero. So we're not as fussed about their carbon intensity as we speak today, because they are required. We apply a shadow carbon tax across all of our main, particularly our Australian assets. And even though we're far from having a carbon tax imposed in Australia, we think it's important to understand where the sensitivities will be in our portfolio when indeed heavy emitters are going to be charged for the negative externalities that they're creating. So that's an important development for us, and we're comfortable. It gives us some comfort in terms of the likely pressure points, particularly when we're looking at cost of capital increases across sectors. Engagement before divestment. This is a really big deal for us. There is activism against fossil fuel is now not the domain of just special interest groups. It has gone mainstream, and there's always going to be a cohort that believes that the best solution is to simply divest yourself of fossil fuels, but that to us is not the answer. Firstly, there's a practical thing. When you are actually divesting in public markets, you're transferring ownership from yourself to someone else, right? And we don't know what the intentions are of the buyers. We don't even know who the buyers are. It actually doesn't change the capital structure of a company itself, and it does nothing to actually reduce real-world emissions. There's a signaling impact there, but it actually doesn't achieve what we wanted to achieve. We much prefer the engagement approach because by owning shares, we've got a seat at the table. As soon as you divest, we basically lose the right to call a CEO, to call a chair, and talk about this. We also lose voting rights. So our preference is well and truly to engage. Divestment will always remain an option to us. We have divested in the past. We'll do it in the future, but to us, it's a last resort, not a first, second, or third resort. Provide member choice. Of our 16, we call them accumulation options at UniSuper, but they're broadly known as direct contribution options. We provide 7 options, investment strategies across all risk return spectrum that do not include fossil fuels. So members can vote with their feet if indeed they're in these type of what we call our accumulation options. And finally, reporting and education. I can't recall the last presentation I gave on investments that wasn't climate change related. As a matter of fact, I made the joke. I gave a presentation the other day, and after 30 minutes of questions, I asked them, "Has anyone got a question that's not related to climate change?" So this has become a huge deal for every senior investment professional in Australia, and I imagine it's becoming Europe's probably ahead of us in that regard. The Americans are probably about where we are. It's become probably the most important thing we do. I would like occasionally now to talk a bit about stuff not related to climate change, but that's the way the world is going. So we've got to adapt to that. And reporting. We believe that we've led the market in terms of reporting. Climate risk and our investments. We're in mid-August. We're going to be releasing our 4th edition of this. It's about a 60-page document. We're disclosing our exposure to fossil fuels. There's a whole bunch of things we're doing here. We actually have a company traffic light report where we literally name and shame companies that aren't disclosing their commitment to Paris. As a matter of fact, I'm not going to go through all of them, but one of the companies that hasn't got Paris-aligned goals is the ASX itself. So the Australian Stock Exchange is a listed company. We met with the chairman a couple of weeks ago. We happened to be the largest investor, and we said, we want you to get something on your website. We want you to be committed to Paris, which, by the way, they're not a heavy emitter, but this is the principle that counts. And we want it done by the end of this year. In fact, we want 100% of our actively managed Australian companies to be compliant with this by the end of this year. And the conversation we have are very robust. We tell them in advance that they've got a red light, and we want that at least orange and preferably green by the end of this year. We disclose our carbon intensity across our 17 investment options. So we have a defined benefit option as well as a defined contribution, carbon intensity, and we compare that carbon intensity to a benchmark, just to give members an idea of where they're trading. And then, of course, we've got our fossil fuel exposures. This is just a snapshot of what's a pretty lengthy document, but I'm putting it up there because it's becoming, an increasingly important document. It's probably our signature document now, and I think it's going to be more and more the signature document for most pension funds in Australia. Right, now let's talk about some of the lessons. I'd say we are still learning because we're still at the early stages of what's going to be a really long journey. The first thing, and I think this point was made before, that corporates and markets are adjusting very rapidly. So as a matter of fact, if it was purely left up to the corporates to get to net zero 2050, I would say with total confidence we would get there. But I'll get into the point in a minute. It's not just corporates, but we're seeing corporates, I reckon 3-4 years ago, having a discussion about alignment with Paris. It would have been a non-discussion. It would have been pretty tough to get someone to commit publicly to aligning with the Paris goals. We're seeing now, because of the mainstream activism, we're now seeing fund managers, we're seeing corporates responding to that. And I believe that by the end of this year, we're a good chance of getting 100%, as I said, of our key actively managed Australian investee companies to align with Paris. The markets are adjusting rapidly. The previous speaker alluded to option pricing. I haven't looked too carefully in that because the option market sometimes sends mixed signals based on liquidity. But what I can say is the observations I've made is just if you look at something as simple as what the dividend yields are on companies that have got fossil fuel exposure, they're trading at a real huge margin to the average company, and so you can see that the markets are repricing really quickly. I remember having a conversation. Well, it was actually a strategy session with my team. It would have been in January 2019. I was talking about decarbonisation. I was saying, look, be prepared that over this decade, the cost of capital for fossil fuel related companies is going to steadily increase. I was actually wrong on timing. I think it happened really within the next 12 to 18 months. So it's happened a lot faster than we expected. And I don't see this being unwound. I don't see a whole bunch of investors taking advantage of the high dividend yields for a coal producer, et cetera. I think these companies are going to stay unloved forever, basically.
Excuse me, John, 1 minute.
Sure. A couple of these things that one's a really obvious point. This point has been made before. We need to close the data gaps. A lot of pressure is put on investors to disclose, but at the end of the day, we're only the aggregation of the debt and equity we hold in companies. And so we're only as good as the companies that we invest in. There needs to be some mandated compliance with TCFD, and we need to be much further down the track in terms of science-based targets. Transaction opportunities. We talk about risks. I'm actually thinking transition now. It's actually more opportunities than risks. There's going to be trillions of dollars required of investment to get to a 1.5 degree Paris-aligned world. If you're a good investor, there's plenty of opportunities to make money in that. And finally, it's going to be impossible to please everyone. At one end of the spectrum, you've got people saying, look, just make the money, give me my pension. And at the other end of the spectrum, you've said, look, unless you divest, we're going to desert you because you're contributing to a climate catastrophe and we're never going to like you. I don't think we're ever going to appease those two extremes, but we have to live with that. Thanks very much.